So once again, welcome to the State of the U.S. Early Stage Venture Q4 2021 report webinar. Again, my name is Brooke Jones. I'm on the events marketing team here at Silicon Valley Bank, and I'm so excited that you are joining us today. Before we get started and I introduce our amazing speakers, a few housekeeping notes on the Zoom side. So all lines have been placed on mute to prevent any background noise. And please feel free to submit any and all questions for our speakers via the Q&A button on your Zoom bar. The chat function will be disabled, but we are able to see any and all questions that you submit. So please utilize that feature throughout the event. Also, to activate the closed captioning feature, please click the live transcript button also on your Zoom bar below if needed. And then lastly, we will be emailing all live attendees the replay of today's event in the next few days. So keep an eye on your email for that. So let's go ahead and get started. I'm pleased to introduce our featured speakers, Abe Othman from AngelList and Blake Armstrong from Silicon Valley Bank Startup Banking Team. And Abe, I'll go ahead and pass it to you.
Hello, everybody, and thanks for joining us. Would also like to thank SVB. I'm in the SVB Austin office. So that's the Austin, Texas skyline behind me. So wanted to thank them for putting me up today here. AngelList, if you don't know about us, we are, by some measures, the world's largest early stage investor, a platform matching GPs with great deal flow and LPs who want to invest in those early stage deals. AngelList has really unmatched visibility into the early stage investment universe. In fact, the platform has closed more than 26,000 investments into nearly 15,000 startups over the past 8 or so years. So delighted to be running this series with SVB in partnership with SVB to combine the unique insights that we each have from the data sets that we're looking at. So I'll hand it over to Blake for an introduction and to get us started.
Thanks, Abe. Actually, before I dive into mine, Abe, would you mind giving the crowd a bit more background on you personally and what you did before AngelList and how long you've been there?
Certainly, yeah. So I've been at AngelList now for almost 3 years. I started the data science team. My academic background, I have a PhD in computer science and a couple-time venture-backed startup founder and also an early stage investor. So that was kind of my background. And then at AngelList, among data and research, I also am on the investment committee for the early stage quant fund, which is a fund that AngelList recently raised to invest in principally in the startups who are hiring the best on the AngelList talent platform.
Very cool. Awesome. Well, it's a pleasure to do this with you. And we at SVB appreciate the partnership with AngelList and look forward to doing more of these in the future. Hi, everybody. My name's Blake Armstrong. I'm with Silicon Valley Bank Startup Banking Practice. I've been with SVB for coming up on 6 years now. I started my career in microfinance, and if there's been one thread that you could connect all of my career moves with, it would be supporting entrepreneurs. So whether that's doing microfinance in the developing world and supporting entrepreneurs that are building their businesses there. Or I also founded a startup in France and was doing venture capital work in France before moving to San Francisco to join SVB in 2016. And I've done venture debt deals at SVB. I've been on a few different teams, but now I get to work with cool guys like Abe and AngelList and lead up some of our partnership efforts for the early stage at SVB, which is a lot of fun. So with that being said, let's dive into the presentation. I believe all of you should have received a link to the full report, but we're going to highlight a few of the insights that we pulled out that we thought were worth bringing up on this call. And we have plenty of time at the end of this for Q&A if any of you want to ask Abe or me any questions or dive a layer deeper about any of these slides. So with that, let's just dive in here. So a lot of these slides are fairly self-explanatory, but one of the things that we noticed was the payroll spend versus overall spend index here, and how much payroll as a percent of total spend has been increasing throughout the pandemic. And there's a slide later on in this deck that refers to individual vendors and where that payroll spend was going, which has been pretty interesting to watch. And this trend started back during COVID and has only been increasing, as you can see with the lines that we've laid over the bar graph there. Next slide, Brooke. Also by sector, you can see fintech's strong performance throughout the pandemic. And our kind of hypothesis here is that with a move toward everything going virtual, a lot of, we don't even have hardware, which is another vertical that we track here at SVB on the slide, because we wanted to just show that fintech, enterprise software, and consumer, all software-based businesses, have been increasing relatively in parallel throughout the pandemic. Next slide. And over to you, Abe.
Thank you so much, Blake. One of the key statistics that AngelList looks at in terms of our data each quarter is we look at the entire set of startups that are active. So they haven't exited, they haven't wound down, they haven't been acquired, that we have seasoned investments into at the start of the quarter. Seasoned investments means that we've held the positions for at least 6 months. And then what we do is we look at over the course of the quarter, what happened to the price per share of each of those investments. So, there are sort of 5 things that can happen to a company over a quarter in terms of price per share. The thing that happens virtually all of the time, or, in general, like 90% of the time, is that there's no change in the price per share of that company. But the company could be marked up, do a price round at a higher valuation. They could exit up. The company could exit and then all at a higher price per share than than what we had on the AngelList books. The company could do a down round, so the price per share could fall. It's worth noting that a lot of headline flat rounds would typically be a down round on a price per share basis because of the additional dilution, and then the company can exit down. Those are typically wind downs as opposed to acquisitions at a lower price. So as you can see so what we do is each quarter we go and plot what happened to the companies in the data set. What makes this unusually rich is the number of companies that we're monitoring. So for the fourth quarter of 2021, we are looking at nearly 6,000 active startups that we had seasoned investments into for this quarter. So really very, very, and most of those companies will be seed or Series A. So a really vast data set of companies to look at here. So as you can see kind of from the data, the top plot here, it plots the positive outcomes, mark up or exit up in kind of shades of orange, and the negative outcomes, mark down or exit down in purple. And that dashed black line is the median outcome. So one way of kind of capturing the general kind of venture sentiment or trend is to look at the median outcome that happened in the quarter and sort of how far above zero is it, right? That indicates sort of a general expansion or positive activity. And what we see kind of over the course of 2021 is a peak around the second and third quarters, and then kind of a little bit of a pullback in the fourth quarter, although activity was still very high and very positive by historical standards. So I think you can see, given the dashed black line there on the top chart, that actually, if it weren't for the first 3 quarters of 2021, the fourth quarter of 2021 would actually be, in some sense, the best quarter ever for early stage venture capital. The bottom plot is just a measure of activity. So the purple shaded area represents the fraction of startups that had any activity, where we define activity as the price per share changed over the course of the quarter. I think that one's interesting because you can really contrast 2020, where we saw sort of record low rates of activity, where there was a lot of uncertainty about fundraising in the markets during the sort of the brunt of the pandemic, and contrast the activity rates in 2020 with the activity rates in 2021, which were much higher. So you can definitely see a recovery in activity comparing 2020 to the second, third, and fourth quarters of 2021. So the general story is by historical standards, both activity and the tenor of that activity were extremely high in the fourth quarter of 2021, but slightly lower than the second and third quarters of 2021 as well. I think we go to the next slide. What we track here is actually just a different way of thinking about or plotting that data. So this is actually annualized data. So one of the unique things that we're doing for a fourth quarter summary is that we also have summary data over the entire 2021 year. So this is annualized data. So looking at 12 months of activity by the same metrics. So we have a pool of several thousand startups that we had seasoned investments into at the start of 2021. And we just saw like what happened to the price per share of those startups over the year. Where again, you know, are they marked up? Do they exit? Or do they wind down? The x-axis here is the activity rate. So this is again annualized. So you can see that's the fraction of early stage startups that change their price per share over the course of 2021. You know, that net value ranges from, you know, the low there is kind of right during the pandemic where it was just over 25. And then the high was 40% over the course of a 12-month period. And then the y-axis is the percent of activity that was positive. So essentially we take the numerator are markups or exit ups, and the denominator is sort of the entire set of activity. And that ranges from 65% to almost 90%. And in fact, what we saw on an annualized basis here is that 2021 was actually, you know, on an annualized basis, the best year that we've had for early stage venture capital. A reasonable fraction, right, of companies did do financings, and of those financings, a much higher rate of them were markups than in past years. So we would describe 2021 as sort of the best year ever for early stage venture capital, at least in AngelList data. We can do the next slide. We also track valuations of the deals we see on the platform. So this is what we're showing here. These are actually the annualized statistics for 2021 for all of the deals on the AngelList platform in pre-seed, seed, Series A, Series B. I think a couple data points worth noting here is certainly in 2021, it is now established that sort of pre-seed is the new seed. You know, when I started my first company 10 years ago, and you would ask sort of what round would you describe has, you know, a median valuation of $8 million and 20, you know, quartiles of $5 and $10 million, I would have said, well, that sounds like a seed round. At this point, those are pre-seed rounds. Another valuation note is that the median Series B deal on AngelList in 2021 had a pre-money valuation of $200 million. So it is still too early in 2022 to see what the valuation trends will be in that year. But certainly for 2021, these are the highest valuations that we've seen. And certainly by these standards, pre-seed is the new seed for sure. Next slide. One thing that we began tracking recently that I think is a real cause for celebration is that funding to female founders was at an all-time high in 2021. So that's both by the percent of syndicated deals on the AngelList platform with a female founder and in terms of the percent of capital deployed. So both of those were at record numbers on the AngelList platform in 2021. You know, one sort of thing you can note in this plot is it looks like each year the percent of capital deployed is smaller than the percent of syndicates for female founders. I think that can be attributed to the fact that there are, you know, if you have fewer early stage companies a few years ago, that means you have fewer later stage companies now. Later stage companies are with female founders. Later stage companies are the ones that would skew the percent of capital deployed figures. So the hope is that in future years, we'll see an uptick in the percent of capital deployed as the early stage startups that have a woman founder today become late stage startups, you know, in 2 or 3 years. And I think next slide is back to Blake.
Awesome, thanks, Abe. So we've got 3 more slides here that we wanted to pull just kind of some general data on trends that we're noticing in the ecosystem. I referenced earlier that we had some vendor data as we were tracking the spend of where our clients are putting their capital. And this kind of lays out the top 10 vendors per spend category in 2021. And there are a few things that stuck out to me as I looked at this. One is that TikTok is in the first 10 for advertising, or the top 10 for the first time. I thought that was interesting. 2 was when it comes to payroll, you'll note that Upwork, Fiverr, and these are contracting platforms. So you're paying contractors, not necessarily full-time employees. And in the past, when we've run these reports, like last year and the year before, those are much lower on the list. And you also note the proliferation of, this has been a trend that we've picked up on for a while, but cloud compute and this idea of multi-cloud. And this isn't reflected on this slide, but what's interesting is we see our clients spending oftentimes capital on multiple cloud platforms. They're not necessarily all in on AWS or GCP or one or the other. They can be spending money on multiple clouds so that they have redundancy built into their systems. Next slide. This kind of tracks, at least when I saw this slide, I reflected on my own life and the changes, my own personal spending from when the pandemic started in Q1 of 2020 to the end of last year in Q4. You see that at the end of last year, we're basically getting back to where spending was in Q1 of 2020 on airlines, which I thought was interesting. You see spending, that's the dark purple line at the bottom, dropped pretty much all the way to 0 throughout the pandemic, has kind of slowly climbed back. You can see the rapid increase in video conference spend. One thing that struck me as a little interesting was the food delivery drop off from Q3 to Q4. I guess people were sick of ordering Uber Eats and DoorDash at the end of last year, but that's interesting. And I'm interested to see now that Omicron, it feels like we're starting to see the light at the end of the tunnel at the end of Q1, what these spend categories are going to look like at the end of this quarter. But next category, next slide. And this, not much to layer on here other than to note that we broke out the top hubs for startup formation by location in the US. So you can see the top hubs and the percentage of the overall market that each one of those hubs captured. And one thing that struck out to me is we broke out San Francisco and Silicon Valley as 2 separate things here. But if you combine them, then that's 21% for the Bay Area in general, which is still, San Francisco has a meaningful role to play in the tech ecosystem going forward. Albeit, I think startup activity obviously is a bit more distributed now than it used to be, and that's a great thing. SVB, by the way, even though Silicon Valley Bank is our name, we have offices in 28 cities around the United States and coverage in each one of these markets that we have laid out on this slide. So next slide, Brooke. I believe that's it in terms of content for the deck. We can open it up to Q&A. I saw there was one question that came through from, was it Matt? Was asking about healthcare and like healthcare numbers. And I asked the team in the background, and we're actually going to be doing a presentation on that at the end of Q1. So stay tuned for breakouts in terms of vertical for like life science and healthcare companies in our next presentation that we do.
I see, Blake, one thing I wanted to just note about the geographical distribution of startups is one interesting phenomenon that AngelList does track. We do look at kind of the performance of investments in different places, and actually, I don't have a great explanation for why, but it does emerge pretty clearly in the data that startups that are founded in emerging hubs, which I would say Austin, Denver, Boulder, like Seattle, Miami, tend to actually outperform, at least in terms of markup rates, investments made in Bay Area companies, which is something we've seen over the past few years in our data. I don't have a coherent explanation as to why, but I think that dynamic will continue to push investment activity sort of outside of the Bay Area. Although, as you note, there is it still captures between San Francisco and Silicon Valley. It's more than 20% of tech companies founded in 2021.
Nice. Abe, I think if we just open up the chat, we can kind of go back to the beginning and scroll through some of the questions that folks are answering, and maybe we can take turns answering them live or kind of take a crack at it together. Does that work?
Yeah, that sounds great. I'll start with this one about, I presented a lot of data on Brandy's question on price per share of non-public companies. So AngelList does have a formal valuation policy, which I think is at angellist.com/valuation. But just to speak through it, essentially we only look at priced rounds. So only priced equity rounds are reflected in terms of AngelList data. So if you raise a SAFE, that does not count for price per share change. We do use SAFEs for the valuation statistics in terms of fundraising, right? Especially that's the case for pre-seed rounds where 80+% of those are done on SAFEs on AngelList. So we can't really look at price rounds for that. But in terms of price per share, we look at priced equity rounds only. And yeah, there's nearly 6,000 companies that went into our quarterly data for that. So again, the amount of activity you see is roughly about 10% of companies will change their price per share over a quarter. So we're talking in terms of a data set about 600 companies, which is quite large from the perspective of the universe of early stage investments.
Thanks, Abe. I see the next question on here was, what are the panelists' opinions about expected trends in 2022? Will these trends continue, flatten, decline? I mean, coming from a financial perspective, working at SVB, we pay pretty close attention to what the Federal Reserve does. And the Fed has indicated that they plan on raising interest rates in 2022. I've heard estimations of up to 3 times throughout this year. And historically, at least, if you're looking from a macroeconomic lens, typically as interest rates rise, asset prices fall. So it'll be interesting to see what that does to valuations in the private markets, and if some of the if the beta that we're seeing in the public markets will extend into the private markets. It's anybody's guess. I think if there's anything that COVID has taught us, it's that technology is going to play an increasingly important role in our lives, and did play an important role in our lives in keeping us connected and working throughout the pandemic. And I think it's cemented a lot of new habits that will carry into the future. So even if public markets and private markets multiples may be coming down, maybe, I do think that the tech sector there's a good argument for why the tech sector would be less impacted than other sectors in general by that kind of a trend. I don't know if Abe, you have anything to add to that question, or?
Yeah, I think we're likely entering some, at least in recent times, uncharted economic territory over the next year with interest rates going up. In general, I've always thought that interest rates are sort of the greatest enemy of early stage investments, largely because the money you invest today you won't get back for 10 years. So there's a lot of time discounting. On the other hand, I think I'm not sure if the enemy of early stage investing are interest rates per se, or real interest rates. So if real interest rates actually stay negative, it may not have a huge impact on early stage investing. So, I think I've shared this in previous quarters. My own personal experience raising money for early stage ventures, when we raised money for my first company, we definitely had seed investors who came in that if they could make, 3 to 5% real return on money in a bank account, they wouldn't have invested in our company. But because they felt like they had to take some risk in order to make a return, early stage investing was much more palatable to them. If they were going to invest the money in the stock market, hey, at least investing in this company, we've met the founders and we think they know what they're doing or something. So I am I think the effect will be ambiguous. I think that if real interest rates were high, I think that would be harmful. But I'm not sure, even with the Fed raising rates, that that real interest rates will be significantly above zero. So I think, but we are entering, like I said, who knows what's going to happen over the next year and what the dynamics are going to be. But I think there's at least a story where even with kind of nominal interest rates going up, it doesn't have a huge effect on the early stage asset class.
Nice, thanks. I see Boris asked, what should we expect in fundraising in the next 2 to 5 years? Well, if I had a perfect answer to that, then I'd be a venture capitalist and I'd be making lots of money, I suppose. But what I can do is speak to publicly available information and some things that I can share from SVB's perspective that we see on the fund side that will impact the fundraising environment in the short to medium term. We at SVB bank over 50% of all venture-backed technology companies in the US and around 60% of all venture capital funds. So we do have insight into fundraising cycles, both for startups and for funds that back them. And one thing that we have seen is record-breaking LP investment into the venture capital class as a whole that has continued through all of 2021. Which means that VCs still have a lot of dry powder in the funds that they've raised in the last year. There's a lot of capital that's been raised but not yet deployed, which means that over the next 2 to 5 years, you could expect that that capital will be deployed into the tech ecosystem. So I don't think capital scarcity will necessarily be an issue. I think valuation compression and multiple compression is probably a bigger worry, but as Abe kind of laid out in one of the slides, pre-seed is the new seed, and a few years ago we were saying the seed is the new Series A. We've seen a flight to quality, even as the amount of capital in the ecosystem has increased. We've seen bigger rounds, but not necessarily for more companies, but just investors doubling down on winners. And I would expect that to continue as well in the next few years, but only time will tell. Abe, do you have anything to add here?
Yeah, I actually think that segues nicely into a question that we got in terms of how AngelList defines seed versus pre-seed. So as we said, kind of, pre-seed is the new seed. If we had hard if we had like hard bounds on a seed round is, a maximum of $10 million valuation, we wouldn't get that statistic. So it's worth just noting in terms of the way AngelList collects data, that's sort of human labeling by acclamation on the part of our GPs, the deal leads on the platform, as well as our investment operations team. So it's more, I would describe it as, and if you look at the sort of the trend of the data, it's kind of just like a slow accumulation that has left us at the point where a pre-seed round looks like a seed round 10 years ago. We don't have any hard and fast rules about what a pre-seed round is versus a seed round. If a lead investor is calling something a seed round, we call it a seed round. If the company is calling it a pre-seed round, we call it a pre-seed round. So it's more kind of this flexibility that has let us sort of capture this increase in valuation. It is, I think, actually, would be interesting to see if there emerges sort of a pre-seed round that fills kind of the 5 million and below valuations that would typically have gone for pre-seed companies 5 to 10 years ago. I'm not sure if such a thing will emerge or what we will call that, but there may or may not be a hole in the market for that now.
Nice. I believe this is your data, this next question, Abe. Why is the estimate of funding to female founders materially different from the number reported by PitchBook? Is that something you can speak to?
I'm actually not sure what the PitchBook numbers are. I do know that this, and I saw a question about like Latino founded startups. A lot of this data is either self-reported by founders or reported by kind of GPs on the behalf of founders. So we may be seeing different cuts of the universe. I also know that in general, for summary statistics, AngelList does focus more on early stage investing. And one of the, obviously at the early stage, companies are raising less money. It gets a little bit fuzzy, I think, especially for folks that have less early stage coverage and more late stage coverage like PitchBook. Some kind of like mega deals, which are right on the border between VC and PE, do end up skewing statistics for what venture capital looks like. Because if a company raises, hundreds of millions of dollars, that's enough to like swamp out, $100 million pre-seed deals. And so, I think that we are sort of looking at different slices of the universe. I'm actually not sure if the PitchBook numbers are show higher or lower figures than what we have. My guess would be that they would show lower, at least on a percent of capital raised basis, because the dynamic was, if 5 to 10 years ago fewer women were starting companies than they are today, that means that there will be fewer like very late stage companies today founded by women. And as a result, especially if you at all include late stage data, those will just have the effect of super skewing the numbers. And you see that as well when you consider things like, how big is the market for U.S. or U.S. venture capital or U.S. early stage venture capital, and one of the questions there is like, what do you define as venture capital or early stage venture capital? Because as it blurs into very, very, very large late stage private rounds, is that really venture capital or is that more private equity? And if you include those statistics, the number can look maybe much bigger than it sort of in some sense actually is. We unfortunately at AngelList, we just sort of punt on that question because we see so much, or like our deal flow is wildly disproportionately, especially in terms of count and in some sense in terms of funding as well, so much skewed towards the early stage of people raising their first round of capital in a syndicate on the platform.
Nice. We have an anonymous question about, do you have data on those seed and pre-seed companies, how they got to those amounts and help show a high valuation? I don't think it was about any one of those individual, if I understand the question correctly, I don't think it was about the individual companies and their performance. I think the valuation expansion is more of a macro trend. It wasn't necessarily reflective of the performance of like individual companies. It just kind of got to be normalized in the market that pre-seed or seed companies are going out and raising, a $15 million valuation, and that was just where the benchmark was. But Abe, do you have anything else to add to this?
No, I think it is driven in large part by sort of market terms and competition for earlier stage deals. I think founders have a sense, especially over the past year, that the market is willing to pay more for especially high signal startups at the early stage. And as a result, I think that has driven an increase in valuations.
Looks like this next question is more for you, actually, Abe. How do you become a part of AngelList as an investor or entrepreneur?
Yeah, I saw that one, and also there was a question about like finding VC funds. So just a word about AngelList and the way it operates. It is only for accredited investors. You can find the SEC accreditation status stuff. One thing I'd suggest in terms of, certainly nothing is investment advice, but AngelList does operate, and GPs on the AngelList platform do operate a good number of rolling funds, which are like quarterly subscriptions to venture funds. And those funds, because of accreditation rules, that they are allowed to publicly advertise. So I encourage you, if you're interested in like, I want to invest in venture capital, like a great way to get started is, could be to go to angelist.com/rolling and check out the rolling funds that are publicly advertised on the platform. You'll find GPs who invest in everything from NFTs to clean tech, focused, to enterprise software, and I think that could be a really interesting way to get started investing in venture capital. For what it's worth, we see it on the platform. I feel like I have to give this disclaimer, not investing advice, but I can tell you that the AngelList LPs who are exposed to 3 or fewer companies, the median LP loses money. What we have seen in our data is that the LPs that the median LPs by number of investments increases sharply as the number of startups that the LP is exposed to increases. So one of the reasons that I think rolling funds could be a good fit for individual investors is that you're investing in a fund that invests on a quarterly basis. So you get exposure to, 5 or 10 deals per quarter that GP is going to do. And that's a good way of diversifying the portfolio, because we see it in our data. Having exposure to 1 or 2 early stage companies is really a recipe for disaster. Those LPs in our platform generally lose money.
Nice, thanks, Abe. I see a question from Mateo here. Are you seeing a dip in startup funding in Q1 of 2022 related to the market volatility in tech? And there's a follow-up question. If so, is it expected to stabilize or recover? We're sitting here at the beginning of February, so we're not that far into Q1 of 2022 yet. And I would say that historically, we see a bit of a dip in startup formation and funding in January, around the first week of January, because folks are just getting back from the holidays and ramping up, and that's been reflected in what we've seen. But I wouldn't say there's been a dip in new company formation or onboarding for us since people have gotten back from the holidays, despite the market volatility in tech. I'd also say that there's no better time to start a startup than a recession, or when times aren't great. Like we found historically that actually that's when we see spikes in startup funding and formation. So even if there were market volatility and that were contributing something to the ecosystem, that wouldn't necessarily be a negative signal. It could actually be a positive signal. And in terms of stabilization and recovery, we'll just have to see what this year holds and the macro trends that we talked about earlier, interest rate hikes and other things. No one has a crystal ball there, but it'll be interesting to see how it plays out. Abe, do you have anything on that?
Yeah, I'd like just to follow up with a response to a follow-up question, I think, from an anonymous attendee about, is there a relationship between the stock market and venture capital or venture capital funding? I think one of the interesting things that we've seen in our data is that there's essentially zero correlation, on a monthly basis between the performance of investing $1 in every seed deal on the AngelList platform and the NASDAQ. And I think what's further interesting is that we didn't see any lagged effects either. So it's not like, oh, the VC follows public markets, but 6 to 12 month lag. We didn't find any evidence in support of that either. So it's our belief based on the data that actually the markets look pretty uncorrelated, at least at the early stage. I think for late and very late stage companies that are looking to IPO, I think there has to be effects between if multiples get crammed down, that's going to affect very late stage. But for the earliest stage of companies, those really do tend to look like binary options on success or failure of these businesses, and that tends to be fairly independent of what's happening in the public stock market or what's recently happened in the public stock markets. So I think that is an interesting trend. Also for what it's worth, right? VC funds tend to have a little bit of anti-cyclical properties in them because, as public stock markets do really well, typically it becomes easier for VCs to raise money, and then they'll have to invest that money over the next 3-year stretch. So I think not that I've done deep research into this, but one thing that could explain the phenomenon of during recessions or turbulent times, those are actually excellent times to start companies, is that VCs are still sitting on a bunch of cash from other things. The other idea is that when times have been bad for a while, the bar for a new company formation can be very high. And so it's only, the best opportunities that start during the downturns. So I think there are some competing effects that could be happening there, but I do think because, VC fundraising tends to lag sort of what happened in the public markets, 2 or 3 years ago in terms of the amount of money they're putting out the door. You do get a little bit of an anti-cyclical effect, which I think is generally, a positive thing for the economy.
That's very interesting, Abe. One more note on valuation at the early stage in terms of advice that I give to entrepreneurs when I'm sitting down with them. As in the data that Abe showed earlier, we saw that multiples and valuations are at all-time highs at the early stage. And with what we shared about some of the macro market dynamics that may or may not play out in 2022, I would just keep this word in the back of your mind, valuation overhang. And it's something that we always advise entrepreneurs to be cautious of, which is that if you're going out and you're raising at a very high valuation historically, if you look back over 5 or 6 years in terms of the multiple at which you're raising, be conscious of the fact that at your next fundraise, you're going to want to be raising at an upmarked round, which means you're going to have to grow into an even larger valuation down the line. And keep that in mind as you're raising your seed and pre-seed, because a higher valuation is not always better for you as an entrepreneur at the early stage. It can come back to bite you in the future, and bigger is not always better when it comes to this.
Like that's a super interesting point. We did a blog post, I think in 2021, looking at what startups founded by founders who went to which schools have the highest markup rates. And one of the interesting things that emerged there is that the best schools for markup rates tended to be very good, but maybe less on brand, or less schools that would less come to mind. So, I think the top 3 were something like Brown, University of Waterloo, and University of Washington. And the reason why is that, in fact, if you look at the data, right, like, there is a positive effect for investing in a founder who went to, say, Stanford GSB. But what we tend to see in the data is that actually, the founder of that company knows that going to GSB is a high signal for their startup, and they tend to capture actually the bulk of that of the boon from that high signal in terms of the higher valuation. And so it actually becomes harder for investors. So it is the case that companies founded by folks who went to Harvard or Stanford GSB or whatever, they do have higher markup rates than companies that don't, but that the delta is actually smaller than you might otherwise think. And the reason why, at least in our data, seems to be that those like high signal founders tend to command higher valuations, which makes it harder for them to raise
subsequent rounds. Yeah. Wow, that's really interesting. And yeah, so the bar is set higher for them, and they got to keep raising the bar as they go along if they want to one of those top tier schools. Interesting. Let's see here. Any stats on return to office, well-beings, and energy efficiency? Not sure what the specific question here is, but I know that SVB is starting to go back to the office globally, and we've been running return to office trials for about a year now, and we're starting to actually make a move to do more things in person finally. And we've been pretty conservative when it comes to what we've been doing in market. So I don't have any specific data on what the market is doing in this respect. Abe, do you have anything on this?
Only the anecdote that SVB's office is in Austin here is at the top floor of a very nice office building. The other half of the floor is a tech company that I'm not going to name, and whose offices are completely empty when I walk by them. So I think one thing I would love to see, like if it's possible in the future, is I don't know if you guys have rent spend as part of that. I'd love to see if those numbers are going kind of up or down. I thought that spend data that you all have is absolutely fascinating. I thought the airline spend and crashing to almost zero and now recovering in the fourth quarter, I think is really fascinating stuff. So would just love to keep tracking that data as it keeps coming in, because I think that's a really amazing indicator for what startups are spending their money on now.
Thanks, Abe. And yeah, interesting anecdote about Austin, Texas. Praveen is asking, what's the best way to reach out to venture capital investors? Do SVB or AngelList offer any resources? I'll let Abe speak to AngelList, but Praveen, if you're an SVB client, get to know your banker, get to know the person, put a face to the name of the person who's working with you on your accounts. And we absolutely will facilitate venture capital introductions when we feel like it's appropriate, when you're at the right stage. That's a big part of my job, is advising entrepreneurs on how to prepare for their first investor meetings and then facilitating some of those introductions. So with SVB, it's kind of a one-to-one relationship that you're building with your banker, who can then work with you to prepare you as you're wanting to go out and raise a round, and then can even broker some of those introductions. So Abe, what do you guys do on that?
Yeah, I think I saw this question 3 or 4 times in different flavors in the Q&A as I scrolled through. AngelList is not a crowdfunding platform. Deals on the AngelList platform are brought by deal leads, also called GPs. AngelList works with hundreds of them, and they essentially raise money for deals from LPs on the platform. But there's no mechanism by which startups can, ask AngelList LPs for capital. AngelList does have a suite of founder products, including this newly formed Stack thing. We also have very popular over 2021 roll-up vehicles, which are essentially self-syndicates, but AngelList will not. AngelList will sort of run the back office for that for founders, and it's a great product in order to get a bunch of small checks into a single line item on a cap table. But AngelList will not help with solicitation of AngelList platform capital as part of a roll-up vehicle. So there are, for folks who are, I would recommend if folks want to go the crowdfunding route, a kind of sister company to AngelList called Republic is a great crowdfunding website and could be good for that. But AngelList itself is not a crowdfunding website, and all the deals on the platform that would be, solicited for AngelList platform capital come from our deal leads, who are the intermediates between the startups and the LPs.
Let's see, Dean's asking about valuation numbers for West Coast versus East Coast. I know historically there was, at least anecdotally, a bit of a premium in terms of the multiple that you would get in Silicon Valley versus other places around the country. I don't have specific numbers prepared now to point to there, but Abe, do you have anything to speak to on that?
Yeah, it's something I'd like to dig into a little bit more. I said that kind of when you showed the map of where startups are being founded, that one of the things that emerges in our data is that actually, it's a really positive signal for future markups to be in sort of an emerging hub, and a negative signal to be in the Bay Area. And I wonder how much of that could be, again, this phenomenon of Bay Area companies demanding higher valuations and then having a harder time raising markups because they're already, some amount of growth or success was already priced into their previous round. So that I haven't looked at it closely enough to say that is what's happening, but that would be a result that is consistent with kind of the stylized facts that we see within our data.
Nice. Let's see, there's a question here. Is there any data on the representations of cash on hand and dry powder by VCs versus the reality? We have noticed a disconnect between the two. Well, if I'm understanding the question correctly, so maybe we can start by talking about how VCs typically work. So to boost their IRR multiples, typically when a venture fund announces they've raised a $500 million fund, that doesn't necessarily mean that they've gone out to their LPs and they have $500 million just sitting in their account. In fact, most of the time, it doesn't mean that. What they have are rock solid commitments from LPs that are bound in an LPA, a limited partner agreement between the fund and their LPs, so that when they need to deploy capital by investing in a startup, they go out to their LPs and ask them to fund. The reason they do this is the time value of money, and to boost their IRR multiples that they are reporting back to their LPs. They want to have cash on hand as a venture capital fund for the smallest amount of time possible. And as soon as they get it, they want to deploy it into a company so that they can get the best returns for their LPs. So if that's the disconnect that you've noticed, then you're totally right. There is definitely a disconnect between cash on hand and the amount that funds announce that they're raising. Abe, do you have anything on this?
This is an area where I think SVB has much better data than AngelList, because the funds on the AngelList platform, I know a huge line of SVB's business are capital call lines of credit to GPs who run VC and private PE funds. On AngelList, capital call lines of credit are not that widely used. I would say almost never used. And on AngelList, the funds that run on the AngelList platform tend to be on the smaller side, and for lack of a better word, get the money out the door quickly. So we have very little, as a result, we kind of have like very limited visibility into dry powder, which I think is typically a phenomenon of larger funds that might make use of SVB's banking services.
Mm-hmm. But I'd also just end on that by saying that dry powder versus cash on hand, it's kind of a distinction without a difference, to be honest. Like the LPA agreements that bind LPs to funding their commitments in funds are rock solid, and so rock solid that a bank like SVB can underwrite to them. So when an LP like CalPERS or an institutional investor makes a commitment to a GP, that commitment is legally binding and is something that we can even underwrite to. So, like I said, it's kind of a distinction without a difference. That money is as good as, almost as good as cash. But as we say in banking, cash isn't cash until it's cash. So, let's see.
I see it, Blake. I see a couple more questions about kind of like founder features. One question about minority founders, and another one about serial or repeat founders in terms of valuation or the access to the AngelList platform. From the perspective of minority founders, unfortunately, there's very limited data about this. We've started collecting an AngelList. I can tell you from looking at the statistics, especially with what we're doing with the quant fund, we love minority founder companies. Like, we think that is a pretty solid positive signal. Those deals do tend to get marked up at a higher rate than companies that aren't tagged as having a minority founder. And we also think that AngelList, just because it lowers the barrier of entry for investing, has a much higher fraction of women and minority GPs than venture capital as a whole. The question about serial or repeat founders, do they command a higher valuation? They do, and you end up actually in this situation again where the signal is, especially if you look at, say, markup rates, it's not as strong as you think it is because it is positive, but again, the repeat founder tends to capture the bulk of that surplus in terms of a higher valuation. So that's, I think, a trend that we see, similar to the folks who went to GSB. Those are in some sense good deals, and they're in some sense not as good as they could be for investors. Actually, the feature that we've found at AngelList that we use pretty heavily, that's a great predictor of markup rates, is the founder of a company being a past early stage investor, because typically, that means that they're accredited. So they're going and starting a company, has reasonable opportunity cost. If they're an investor, they've probably seen a lot of pitches so that they hopefully have a sense of what a good or bad pitch looks like, and they won't, spend the next 5 years of their life working on a bad pitch. And yeah, I think and typically they'll have like a network if they're already an investor that will help their company along. So that actually we tend to actually fit on whether one of the founders of the company has done early stage investing, not whether they've started a company before.
That's very interesting. I wouldn't have guessed that, actually. Thanks for sharing that. We've got time for about one more question, I think, or I have time for about one more question. So let's dive in here. I see this one is kind of interesting to me. Is there any data around average mean time from seed to A to B, and so on, and the percentage of startups that go on to the next stages? Abe, I'm sure you've got some interesting things to say about this, but in general, I would say from SVB's perspective, as we're doing venture debt deals on the back of whether it's a seed round or a Series A, typically it's, I would say, 12 to 18 months is what we see in terms of time between rounds. And I would say that 12 isn't better than 18, 18 isn't better than 12. It really, what you're trying to prove there is just product market fit and customer, the ability to attract customers that are paying and retain those customers is like the most important thing within that 12 to 18 month window. In terms of the percentage of startups that go on to the next stages, I would say there's probably a fairly high, I'm interested if you have any data on this actually, Abe, but like there's a decently high rate of seed companies that go on to raise a Series A, but I would guess that the graduation rate from Series A to Series B, anecdotally from what I've seen in the market, would probably be lower because you're really trying to get it depends on it also depends on the fund that's backing it. If you're going with a top tier institutional seed fund, the percentage of deals that go on to raise a Series A from a top tier fund like Floodgate or Uncork or some of the other funds that we work with, very high Series A graduation rates coming out of those funds. Not all of those will go on to raise a Series B though, because that's really where you're proving out product market fit, at least from what I've seen. Abe, do you have anything to speak to there?
Yeah, I mean, this is something that I'd love to spend some time researching in this upcoming year, but I think it is intriguing. Like if you look at the rates that we show on a quarterly basis, only about 10% of the companies change their price per share in a given quarter. How does that suggest, sort of just naively, that it would be 3 months times 1 over 10 would be 30 months. So an average time of like 2.5 years between fundraising rounds. But when we look at the data, we do see, the same 12 to 18 months. And the reason why is that sort of, if you're looking at frequency of markups, the companies that get marked up more are more represented in your markup data. And so I think this is a really interesting thing to unpack. In terms of timing though, we definitely see pre-seed rounds definitely take the slowest to get marked up and kind of overall have the lowest rate of markups. We've actually seen pretty decent markup rates at Series A and especially Series B for deals on the AngelList platform. So I think but the early, like the very, very early stage deals do tend to be marked up slower than other deals.
Great. Well, we covered a lot of ground here, and it looks like we're basically at time. Abe, thank you and AngelList for doing this event with us and co-authoring the report. It's great to partner with you, and thank all of you for listening in and participating. We appreciate the questions, and you can find me on LinkedIn if you want to ping me. Please feel free, and have a great day. Thank you.
Thank you so much, everybody.